Hello, everyone. Welcome to NKBA Live. I'm Bill Darcy, and it's great to be back with you for our live webcast of Brave New Business. Today's episode, generously sponsored by Deep Drawer, a digital marketing company that specializes in services for the remodeling industry, features a great discussion with three top economic experts and researchers. Despite this most unpredictable year, which is still surrounded by uncertainty, our panel will try to shed some light on the road to recovery and the outlook for 2021. For the economy in general and for the remodeling market and specifically kitchen and bath sectors. We'll be sharing the latest findings of the NKBA John Burns Kitchen and Bath Market Index, or KBMI, for this third quarter, which indicates very positive movement for our industry. We've seen improvement in many sectors of the economy, but recovery is still spotty. GDP was up 33% in the most recent report. Sales of existing homes spiked to their highest monthly rate in 14 years in September, and the housing market is strong, with low mortgage rates boosting activity and low inventory boosting home prices. People who are fortunate enough to work from home are renovating to change the function of their spaces. But only about half of the jobs lost during the pandemic have been recovered so far. And as the temporary bans on evictions begin to expire, tens of millions of people may be forced out of their rental units. The stock market has been volatile. However, markets are rallying today on news of better than expected results of a Pfizer vaccine in the latest trials. We'll now hope for great safety data in the weeks ahead. Let me introduce today's panel, who will help us unpack some of this and point to the indicators that are most relevant in our markets. Kermit Baker is a longtime friend of NKBA and senior research fellow at Harvard University's Joint Center for Housing Studies, and is the project director for the Remodeling Futures program. This research effort by the Joint Center provides a comprehensive analysis of American remodeling activity and aims to improve understanding of the dynamics of the renovation industry. Also joining us is my friend Todd Tomalak, principal at one of our key research partners, John Burns Real Estate Consulting. As many of you know, the NKBA and team at John Burns developed the quarterly KBMI, providing real-time insights about our market, as well as NKBA's updated kitchen and bath market outlook. I'd also like to welcome Ali Wolf, chief economist of Zonda, the recently rebranded Hanley Wood Meyers Research Zonda data powerhouse, bringing together its all-in-one data-driven solution set under one brand. Ali manages and analyzes content for Zonda, which specializes in real estate and technology services, providing data analytics, research, and presentations on the housing market and the wider economy. Just some brief housekeeping before we begin. As always, this webcast qualifies for 1/2 CEU credit for our certified members, and we'll have some time for questions at the end, so please type those in the Q&A function at the bottom of your screen. I'd also like to acknowledge Signature Kitchen Suite, one of our 2020 Innovative Showroom Award winners, for the beautiful space at its Napa Valley Experience and Design Center that you see behind me today. In fact, today is the last day to nominate a showroom for the prestigious awards, so check it out at nkba.org and search Innovative Showroom Awards to recognize an outstanding sales organization during KBIS 2021. Let's start with you, Todd. Can you share some highlights from the latest KBMI for the third quarter and tell us what segments are performing best?
Yeah, absolutely. The Q3 KBMI, just encouraging to see. The most recent read was almost up to 62 points. That's after being in the low 40s for the prior 2 quarters due to COVID. What really jumped out, though, to me, I have it highlighted there in the bottom right-hand corner. We ask all the industry participants about what they expect for the full year growth outlook for revenue. And this was the first time we saw this group tell us that they expected net positive revenue for the full of 2020, even though we lost a good number of months this year. So that's quite encouraging. We think things are getting better.
That's fantastic news. What's the status of the project and order pipeline going forward?
Yeah, the project and order pipeline is really where we're starting to see some green shoots. So about 2 out of 3 of the companies that we interview and survey tell us that their book of business looking forward is at least as strong as it was at this point last year. About half of that group overall expects is seeing even stronger growth than they were at this point last year. And the reason that really jumped out to us is when we think back to what we were expecting at this point in 2019, the industry was expecting almost 10 to 11% industry growth at this point last year, looking ahead for next year. So the fact that this group is even more bullish when they look at their order book, that's a pretty strong signal of changing demand, especially among some of the luxury segments.
Yeah, thanks, Todd. Very, very promising for our business. Kermit, for you, as the general economy is beginning to recover, what segments are performing best and what's most relevant for housing and remodeling?
Well, thanks, Bill. I think from a broad perspective, the good side of the economy is doing well. The service side, not so well. So on the good side, things like housing and cars and home furnishings and appliances, all doing well. I did look a little bit at what segments of the economy have actually added jobs since the pandemic began. We're down about 7% overall throughout our economy, but some sectors have actually added. The top of the list are, curiously, couriers and messengers. And I have a hunch that's probably Grubhub and DoorDash and other sorts of food delivery services. Building materials and supply stores, within our own industry is doing very well. Warehousing and storage is doing well. I'm guessing that's really a lot of logistics support for e-commerce and things like that. At the other end, I think there are names that we know. Hospitality is down, sports and entertainment is down, air travel, kind of anything where close contact with other individuals is required is still seeing weakness in this economy.
Yeah, very good. Thanks for providing us that intel. To you, Allie, how necessary was the economic stimulus to the growth we are experiencing, and do you think additional stimulus is critical for further recovery?
Yeah, and thanks for having us, Kermit. I think that our family is single-handedly supporting DoorDash, so we're probably driving some of those numbers up. But for the stimulus is more important than I think we will ever know. So, Bill, when you started, you talked about how the third quarter GDP was up 30%. That's after falling 30% on an annualized basis in the second quarter, which was the biggest drop we've had in modern history. That is depression territory. And if we didn't get things under control, if we didn't give money to people right away, we could have fallen into a depression. And so the interesting thing about this cycle versus last, when everyone's trying to look at the great financial crisis and try to draw parallels, last cycle, we waited until the data told us there was something wrong in the economy to push out so much money in the stimulus. This time around, it wasn't a wait. It was, we're shutting down the economy and we're getting money to you right now. We supplemented 15% of GDP in just the first 2 months to make sure people didn't fall behind on bills. Really important.
Further recovery, critical to get the extra stimulus. You would support that as well.
That's very true. So yes, undoubtedly, yes. Why I was hesitating is there's a lot of debate about, do we do $1 trillion more? Do we do $1 billion more? Which groups need it? I'm kind of in between the two parties. I don't think we need another $2 trillion stimulus, but I think we need a targeted stimulus bill. We need the sides of the economy that Kermit was talking about that are still struggling. They need money. The people of us on this call, we don't need any more money. We're still working. We've been able to save. So we have to figure out that fine line. Great
point. Todd, do you think we've seen the bottom of the recession?
Well, I would agree with Allie. I mean, I think we'd have to, because otherwise we'd be viewing a minus 33% collapse would have to happen again for us to get back. But that said, there's probably a very different story by segment. So certain categories take time to unwind. For example, what the outlook for apartments or multifamily, even commercial, probably be quite different than the outlook for single family or some of these other categories too. Even broad-based spending on hospitality probably has a lot more runway. So broad-based agreement, but it's going to be very different by segment.
And I think if I can jump there, I think that's a really good point, because we're looking at the economy as we're talking about it in aggregate, and we're saying, hey, we're sitting here and our frame of reference is housing and remodeling, and these are thriving sections. But as Todd talked about, multifamily is still facing some pain that maybe we haven't felt yet. The office market is maybe facing pain that we haven't felt yet. And the stimulus right now, if you give money to those sectors without getting the virus under control, you're just slapping on a Band-Aid, and those sectors may continue to bleed. So we have to watch that, but I completely agree.
Kermit, you want to jump into this with your thoughts?
Sure. I think Bill's useful to think about sort of the stages of a cycle. We first head into recession, and then we're in a recovery phase till we get back to the economy as large as it was before it headed into recession, and then then we head into another expansionary phase. And I think we felt the recession pretty strong. That seems to be behind us. Obviously, with a strong third quarter, we're seeing growth now. But I think we're going to be in this recovery phase for a while. I mean, we're just seeing very slow growth. You mentioned jobs, Bill, that we've only gained back about half of what we lost. That's a little disappointing. Where as long as we've been in this, consumer sentiment, consumer expectations still are weak. I totally agree with Allie that we do need more stimulus to get out of this. I've seen estimates. I don't pretend to know the answer. I've seen estimates that we may not get back into the expansionary phase till maybe as late as 2022 without any further stimulus. So, I do think we've slowed down, and we need something to kind of juice the economy a little bit now to get things going again.
Some data to back that up too. If you look at GDP and you look at that 30% drop and that 30% rebound, where we are right now, our GDP, to the point that we're in recovery, we're not actually in expansion. We're not going above where we were this time last year. We're off 3.5% compared to the end of 2019 for our total GDP. And for reference, we were off during the worst times of the great financial crisis, 4.3%. So it shows you that those 30 numbers that we're talking about are just something we haven't seen in years. 3.5 right now compared to 4.3. So we're better than the worst of times during the great financial crisis, but you shouldn't be using the 30 as your benchmark. You should be using the -4 as your benchmark.
Great point. I think people like to talk about the shape, the recovery shape. I don't know if it's just a thing, K, V, and all that. But so can you frame it around that, and Allie, and also talk about red flags, like generally just comment back on what you were just saying, but also then like what should we be worried about?
Yep. So we talk about the shape of the recovery. It could be a V-shaped recovery. It could be a U-shape. It could be L-shape. And we kind of explored all of those as this was happening in March and April, trying to figure out what it is. And the ultimate answer is we're living through a K-shaped recovery. To Kermit's point completely, there are sectors that followed a V-shaped recovery that are thriving. People have a higher net worth. Businesses have higher profitability. But then you have the bottom half of the K, which are the sectors Kermit also laid out: conferences, concerts, anything with travel, tourism, the service sector of the economy struggling. So what we're watching, and I think the biggest risk, is some kind of double dip recession related to winter, related to the fact that we're growing right now, but you're already seeing the colder parts of the globe and the colder parts of the US, think Europe, think Utah, that have now seen people come together closer inside, and they're having to now react accordingly because cases and hospitalizations are going up.
Yeah, unfortunate, but that's what we have to be prepared for, is just to constantly monitor that situation as the temperatures drop, especially northern half of the country. All of you, I'd like to chime in, and maybe we'll start with Todd on this one. What's the area of our industry with the most potential? It could be market segment, it could be business sector, it could be region, really anything. Like, where do you think, Todd, there's the most potential?
Okay, so I'm gonna take a non-consensus call here, and maybe it'll be consensus for everyone on this webinar. But so single-family new construction is clearly going to outperform, but I don't think that's controversial. I think the category of the industry that's going to grow quite strongly over the next 3 years, and generally Wall Street does not believe that's the case, is big project interior remodels. And I'll just give you a few data points. Our own internal surveys have pointed to about 12% of overall big project cancellations having occurred because of COVID. Almost all of those from our data tell us that they're postponed, likely to 2020. The KBMI report we just talked about, that's going to be released, a third of those businesses are telling us that their backlog is postponed into 2021. I see the DIY part falling apart or slowing down substantially, while the backlog of all these interior projects, which were really a pain to do while you're stuck at home with your children, trying to work from home, those are going to come to bear. And incidentally, we're lapping the mid-2000s housing boom, all of which will look quite outdated over the next few years too. So we're pretty positive on interior remodels.
Great feedback. Certainly great for NKBA members. Kermit, where do you see the strength in the market? What's underperforming and what has the potential going forward?
Let me take this from the geographical perspective, Bill. Kind of look at different parts of the country. I talked before about sort of the goods side of the economy doing the best, manufacturing, agriculture, sectors like that. Regionally, you look at that, and that gives certainly a leg up to the Midwest, the South Atlantic states that are heavier in those areas. I think, from a metropolitan perspective, we are hearing an awful lot about population losses from dense urban areas. And I think those are particularly those urban areas that have a vital downtown presence residentially. So those areas I think that are most at risk are Northeast Seaboard metro areas, as well as a good chunk of probably Pacific Coast. And at least temporarily, we hear that those folks that are vacating urban areas are moving to suburbs, small town, rural areas. I think particularly vacation areas. That seems to be a popular destination. Like I said, could be temporary, could be permanent. We'll see. A lot of this, kind of where are people moving from and to, depends on their ability to be effective telecommuters. It's very tricky to relocate if you need to be, proximate to work to perform your job. And so those industries that have a lot of telecommuters, I think, are also seeing a lot more mobility, and therefore urban areas that have a large share of their job base in professions that support telecommuting, I think, at most at risk, because that population can very easily get up and move and work from a less risky area, a lower cost area, other sorts of things that, at least, like I say, temporarily may look more attractive.
Right. How about you, Allie? Where do you see the recovery coming from, most potential?
Yeah, so I agree about what we're seeing with the geographic shifts. And if you think about places like Dallas or Las Vegas that have seen a lot of people move there, I don't think we've seen the full extent of the impact that's going to have on those local areas, because I think it will create this virtuous cycle that if you now have concentrations of people that have left wherever and they maybe worked in similar fields, you can then start seeing companies that follow, and then you can start to see more growth that happens and more people moving there. So I think this will be a really big push for a lot of those really positive in-migration markets. I'm not ready to call. I know that there has been a lot of, I completely agree that people have left the dense urban centers. We see that builders in particular have done well because they were already building in the suburban locations. So they've been able to benefit from that transfer. I wonder, if this Pfizer vaccine, we had the really good results today. Let's say it takes 6 to 12 months to get it implemented. We're all starving to be around people again. And there were reasons people lived in New York and San Francisco and LA and Washington, DC. I'm not calling the end of those. But if you don't mind, Bill, I want to ask Todd a quick question about the remodeling space to see what he thinks. So Todd, I saw someone post recently, and this is not my expertise. I saw someone post recently that during the shutdowns, we've seen so many people rush, and we saw Home Depot and Lowe's, their earnings reports were up and everything was great. And everyone was going through and working with contractors and trying to get these new remodels done. This one person posted, doesn't this mean we're setting up for a pullback in 2021 because so much of it has been pulled forward on that front? I don't know. I'm legitimately asking you what you think.
Yeah, I think if you broad brush it, we totally think you could see declines in DIY project count next year. But let's just pull that apart a little bit. Most of the incremental projects that happened this year were outside the home, backyard projects, decking, lawn improvements, lawn and garden, things like that. If you're locked with your children, they're doing schooling from home, you're working from home, and you probably don't have enough indoor space, it's a horrible time to renovate your kitchen or the center of your home. So completely agree. I think if you roll it all up, there are categories that are going to underperform next year on a relative basis versus this, but that's a different story than saying that people are not that they've already done the pull forward on the kitchen and on the bath, which are everything that we have from a survey standpoint says the opposite. So I think you could see a flip flop in terms of the mix of the type of projects that are done in 2021.
And does that have to assume that we're now not working from home anymore? Do we think that fundamental needs to change, or do you think we've just kind of worked through the easy projects and now we go to the harder projects?
Well, it's certainly a lot easier to put in a patio and still work from home than to tear up the center of your kitchen and tear up the center of your home. So probably that Pfizer vaccine incrementally reallocates the wallet a little bit more towards the interior of the home than the exterior, I would imagine. I don't know that, we've done some survey data on working from home, and everything that we see says that there's a reasonable piece of the population, ourselves included, probably on this call, that will continue working from home, at least in some form. So, is it possible that square footage just gained a premium versus what people were choosing for their homes a couple of years ago? That maybe the fit and finish has just increased, from a mix shift standpoint, we're seeing a little bit more trade up next year. I actually think it's going to be pretty interesting in terms of the amount of wallet share. The bear case against home improvement next year is that we see wallet share revert back to what it was pre-crisis. Sure, a piece of that possibly is true. I certainly hope to take our family on vacation instead of remodeling our home, but there is a subset of projects that were definitely not done in 2020 that there's been no pull forward on, and that's what I was interested on.
I think the issue really is how much pull forward have we seen for different sectors, Todd. I think that's a great point, and probably a lot of the outside work we've seen that pull forward. You have to retrofit a room to make a home office. You probably only have to do that once, and it certainly makes sense that we may some of these bigger ticket discretionary projects that I think a lot of households have been avoiding. Once they feel more comfortable having a contracting team in their home, may decide to take those on.
Great conversation. Thank you for adding that to Allie. I was going to ask you about the consumer behavior, what's likely to stick. I think we kind of talked through that there a bit. So anything that the businesses, Allie, to you, anything that our business will have to do to adjust their models, do you feel based on, obviously we're saying what's predictable here, but anything our member businesses should look at as far as adjusting their models based on the probabilities of those that you were just talking about?
Yeah, and Tim Sullivan works on my team, and he just did a panel, or I guess he had a discussion with the CEO of 5 Point, Emil Haddad, and they asked him about what shifts are you making? You're a master plan developer. What are you saying to the builders? What are you doing with land planning? How are you changing because of this? And he basically cautioned, right now it feels like the whole world has changed and we're not going back to what we were before, but don't put a significant amount of capital into chasing these trends unless you're very confident that they are going to be permanent trends. Try to find flexibility in the space and go back to the basics. What do people care about? People care about the social interaction. People care about whether in their home, outside their home, or out in different areas. How can you create environments that they're still able to go back to the basics of being a human without completely changing your business plan when, if 12 months from now we're back to normal, you got to change it back. So keep focusing on technology. We know that even as we go back, being able to do things just in a more efficient way that we feel like we're getting more out of what we're using, I don't think that's going away. I don't think outdoor socializing is going away. I don't think remodeling is going away because of how many people we have that have refinanced. So even if they go back to home, they may now have more money or an incentive to make their home more important to them because they have refinanced and they've decided they're going to commit to where they are. So I think there are a lot of things, but just don't be too quick to jump and change.
Let's add one more point to that.
Go ahead, Todd.
And go ahead and disagree if you guys, but so the one thing we can say about loan originators is they will drive loan origination volume. So we've had this wave of rate reset refinances that have happened now, and we're going to comp that next year and the year after. And unless you believe that rates are going to drop pretty significantly in the future, the next wave of driving loan origination volume is to drive push cash out. And that cash out will drive a pivot in the types of projects that are going to happen. Typically, Kermit, you've seen the same data we have, but when the HS data says if you fund a project from cash out or HELOC, they're going to spend roughly twice the amount of what's normal out of pocket. That's going to be a story that's not happening now. But I mean, if we weren't talking about kitchen and bath, we're expecting mid-single digit declines in project count next year and mid-single digit growth in overall spending. And so that's 10 points of growth all in all the delta is an average ticket. And I think that it could be higher. But it's an interesting backdrop.
So you lead me to the next question, Todd. Home sales and pricing for next year. What do you see happening? Is home price appreciation locking out a segment of potential buyers?
So we're going to publish a new existing home sales and price forecast this month, and it hasn't even gone out. So I'm going to give you a range because I don't think we know the number yet.
Okay.
We should be thinking pretty strong numbers potentially next year. I mean, I think north of 6 million, possibly double-digit growth. I don't know, or high single-digit to double-digit growth for home price appreciation. And so, I mean, the implications just for housing turnover, the implications for home price appreciation into remodeling in the following year, historically, they've been really meaningful. So we're pretty excited about, the resale market coming into 2021.
Great.
And that,
go ahead, Allie.
You brought up an interesting point about the HPA and what happens with affordability. This morning, I saw that JP Morgan has announced that they're going to ease their lending standards because they have found that home prices and affordability has actually become an issue for some of their buyers, and they're starting to adjust their lending standards, which I think is really interesting because this whole year everyone was saying that lending standards are going to get tighter because now you have a lot of uncertainty around the economy and you have job losses and you have a high unemployment rate and all of these factors, but you're actually seeing a little bit of the opposite because I think as you see parts of the refinance pool start to dry up and you start to run into some different affordability hurdles, this is why Todd is talking about the cash out refinance part, because the banks are now looking around, especially if what happened to the 10-year treasury today holds, which we don't know. But as a lot of you know, the 10-year treasury is linked to mortgage rates. The 10-year treasury today, because of the vaccine, because of the presumed stalemate in Washington, because of what we're going to have, presumably Biden and then having a Republican Senate, they're now expecting there's going to be growth. 10-year treasury has gone up, which should lead to higher mortgage rates. That could just be a today thing. We could see that reset, but the 10-year was at the highest level it's been since March this morning. So we're seeing a little bit of pressure on the mortgage rate side. Maybe it doesn't hold, but watch that when you open the Wall Street Journal, watch that number in the top line, because that will tell you a lot.
And Todd, I would follow up too, just a quick question. Your existing home sales numbers have been very strong, and I think your forecast makes a lot of sense. I'm just curious where this inventory is coming from. I mean, it's been so tight to date, but it does seem to be loosening up now. In the middle of a pandemic, it's not the time you'd expect the housing inventory to loosen up. Any insights on that?
Yeah, I mean, we've looked at that pretty hard. It's a good head scratcher. The only anecdote that I can kind of reach to is when I look at the tightest markets. So let's pick on Indianapolis or something where we're seeing like the average day of listing before it's pulled down is about 7 days. There's a lot of markets where, I mean, the inventory is a monthly statistic, which means it's taken at a single point in time, where we could see the matching happen so quickly between a buyer listing it and then pulling it off that it's just not showing up in the inventory number. That's one theory. And then the other theory is just that the markets are getting more efficient. So maybe it's much easier to match up with a home that you don't have to list it as long as you had to. We know the single family rental folks are coming in. That's part of the reason we're not worried about this potential distress coming into 2021. We've only curtailed our existing home sales forecast by about 100,000 units next year due to inventory. And I don't know what the right number is. But our sense is that it's definitely is not being constrained right now. And I don't know, Allie, if you have a different point of view on that.
No, mathematically, it doesn't make sense that we have the lowest level of inventory across the new and existing home market that we've ever seen without it being some kind of, in home sales at the highest level we've seen since 2005, 2006. How can we have that if inventory is as low as those numbers suggest? So I agree with Todd that I think it's that once homes are listed, I've talked to a lady who worked at one of those big brokerage companies that said there's a lot of listings that they won't even include on their site because they're just snapped up so quickly. So I think that's messing with just the general statistics that we're looking at. My question though, I'm curious what you both, Todd and Kermit, think about this idea of shadow inventory, this idea that we still do have 10 million people that are out of work. And because of the stimulus, they've been able to stay true on their mortgage payments. But next year, if we don't have that stimulus, are we going to see more homes hit the market that, Todd, could suppress or not your double-digit home price appreciation call for next year? If you have more inventory hit, is that going to be welcome news, or is that going to be a little bit of downward pressure on pricing? I don't have. Go ahead.
Yeah, a lot of that, Allie, I think may hit on the rental side first, so it's kind of a separate issue. On the owner side, if prices stay strong, I mean, the reason during the Great Recession where we had the problem with foreclosures was that houses were spiraling down, and you couldn't sell your home to pay off your mortgage, so you were kind of locked into it. That clearly doesn't seem to be the case now. That if you run into problems and have difficulty making your mortgage payments, you're probably living in a home that you could sell and pay off the mortgage, and then you're on your own after that, looking to rent or looking for a single family rental or something like that. But probably we're not going to see the level of foreclosures we did during the last cycle.
Yeah, let's just for a thought experiment, if the entire backlog of forbearance mortgages went on the market tomorrow, it would put us roughly at the inventory level right where we were pre-2007 crisis. And that was a time when we didn't have like all the institutional dollars, right, chasing single family rental. The folks that are in forbearance right now are right in the bucket of where those SFR investors are looking to buy. So just see it as a backdrop of, very unlikely for homes to be listed on the market for a long extended time with repeat price cuts because they're not selling, that there's going to be a much more frequent buyer either for another owner occupant or an investor to buy it, and it won't be a for sale. So that smells more positive on the home price appreciation side. I hope that's right. You guys tell me if you disagree.
Yeah, because what I'm suggesting is not that these turn into foreclosed homes and this becomes a foreclosure crisis. It's people that have not fallen into the forbearance program. They have not used that to date because they haven't needed to, but maybe they're in some kind of bottom half of the K part of the economy that they see the writing on the wall and they need to be careful going into next year, and they put the homes on the market. So I think maybe I'm wrong. I have no idea. I'm not calling for a huge drop in home prices or anything like that. I'm not calling for double digit either, but I just think we need to be aware that could be a shift in the market next year, because even if it is, Kermit, to your point, happening on the rental side, it may be a mom and pop rental that owns the home. So it's still going to be a home that's going to hit the market. It's just going to be a home that is right now a renter is living inside of it. So I think there are a lot of moving parts here.
If you're right, and I agree, if you're right, part of the way that plays out is that let's pretend it's they're kicked out, it's churned, they're tossed out. Look at what Invitation Homes has done to every one of their homes that they bought. It's $30K of incremental, spending on the home interior mostly. So I that's part of the reason I think that the risk on versus risk off, like what's the best part of the market, risk adjusted, looking into 2021, interior remodels is underappreciated considering some of those unique backdrops.
Yeah, so I agree with that. I think that does, if it is the Invitation Homes, when we're talking remodeling and we're talking the audience here, they'll be able to benefit from it. But when you look at just the general wealth gap, you are going to now have investors that come in and buy the homes, and you're going to leave a whole bunch of all of our demographic tailwinds that are on the sidelines because we don't have cash to come in and buy those homes. So it becomes almost a philosophical debate too of who should be buying those homes and what does that mean for the economy? Because if you convert those to rentals, you're still stuck back at square one where you don't have enough inventory.
Bill, we've frozen you out of this.
Hey, listen, you guys are having a great panel here. I'm enjoying it. Thank you for continuing to engage, asking each other questions. This is fantastic, more than we hoped for. But let me before we go to Q&A, let's just layer one other thing on top of this is results of the presidential election. So Allie made a comment earlier about the presumed happenings there, disrupting things here and not having a decision, at least official yet. What are some early opinions of Allie on steps this new or the current administration continue with that we should watch for in the months and year ahead?
I feel like I've talked too much. Kermit, do you want to take it first? And then I'll follow up.
I'd be happy to give you a couple seconds to catch your breath here, Allie. I think Allie's kind of sentiment is right, that looks like we're going to have divided government there. It seems to be pretty much assured. And I think it probably suggests that we're going to be seeing governing from the middle moving forward and looking for consensus. So let me take kind of 4 areas I think that we could generate some consensus on between the parties. Number 1 is fiscal stimulus. I mean, I think that's been a bit of a political football recently. And I think once we get through the election, I do think we'll develop a consensus that we need more stimulus to keep this economy going. And I'm guessing it may be a pretty big one. I would say, a trillion and a half probably is what we might be thinking about for that. Number 2, kind of related to that, is infrastructure spending, an infrastructure program. I think that also got kind of caught up in the political headwinds there too. And I think there is basically a consensus that we need infrastructure to, number 1, kind of rebuild the fundamentals of our economy, and number 2, infrastructure has historically been a very effective stimulus program too. Number 3 is immigration reform. I think we may see some progress there. I think that's super critical for us looking at construction. Immigrants generate a really big share of housing demand, and will generate a larger share moving forward as our native-born population continues to see slower growth. And number 2, immigrants provide an important source of labor for the industry. About 30% of all construction workers, the most recent numbers I've seen, are immigrants. So a key aspect there. And then let me end up with number 4, which is healthcare. I think that sort of, again, has become a bit too much of a football. We'll see what problems we have, what issues we have when the Supreme Court rules on Obamacare. But I think there is the sense that we need to kind of resolve that issue and not keep it swinging in the breeze as it has been for the last decade.
Did you want to comment, Allie, as well, or that was great, Kermit? I mean, I think bringing it into those 4 categories. I mean, that pretty much is the story.
Yeah, and Kermit, as you were talking, I was crossing off my list. Okay, not that. I won't talk about that. I won't talk about that. So the few things I'll leave you with is 1. So I have 5, but I'll go through them quick. Watch the runoff in Georgia, because we have 2 Senate races that are up. And if those switch, then we do no longer have a divided government. And a lot of things we say here will be different, because you have an easier path to get some different policies done. 2, that $400,000 tax increase for people that earn $400,000 plus in a divided government is a lot less likely to get done. And you saw that the stock market has breathed a sigh of relief on that front. 3, when you look at the state and local income tax deduction, that's likely going to get lifted. That won't impact a lot of markets because it didn't on the way down, but it will positively impact actually our net migration markets right now: California, New York, Connecticut, a lot of those bigger areas that have higher price points. 4, state and local taxes. It didn't matter who got in charge. We had unemployment insurance, and we had to pay out initial jobless claims at the highest level we basically ever have. And the states didn't budget for that. And the states are now cutting jobs, and they're cutting services, and they're going to have to eventually do tax increases. And it almost doesn't matter where you are. I think you should be watching for that. And it's not one party or another. It's just, how do we get by as a state? And 5, I know a lot of people are upset with the result. And when we went into this, there was a lot of discussion of who is better to lead the economy right now. And we know that Trump was kind of learning on the job how to live through this kind of crisis. Just take comfort, for whatever side of the aisle you're on, take comfort in the idea that Biden led the economic recovery during the great financial crisis. He was part of the economic team, and we had the longest economic expansion we had on record under his leadership. So whether or not you're happy with the result, whatever, if that is the actual result, take comfort in that, because the economy and getting people back to work is, I think, the biggest thing that we're seeing really on both sides of the aisle.
Todd, you're off the hook with this one because we're running out of time, and we do have a Q&A for you. So Julie, would you give Todd our question from the audience?
Sure. Thank you first to everyone for staying on. We know we're a little bit past our time that we normally end, but we've had such a great conversation, and we did want to continue. So Todd, just a quick one for you. do you anticipate, or how will the lockdown 2.0s that are happening in the UK and Europe impact the supply chain?
Oh, it's funny. So the one part that I didn't talk about was that in the KBMI, but that's basically the rest of the report is the number one issue that we're seeing within kitchen and bath, but supply chain in general, broadly speaking, is a lot of issues just in coordination, particularly around appliances. And I guess if you think about how many little gadgets have to go into an appliance, any one of those can be late or not be at the right place at the right time. So it will cause more delays and prices to go up, unfortunately.
Well, again, thank you for everybody for hanging with us. Thank you, Todd. Thank you, Kermit and the Joint Centers, Data and Ali. And congrats on the new Zonda brand, and appreciate all the great dialogue. Reminder to everyone that the John Burns Housing Summit is slated for November 19th. You can visit their website at realestateconsulting.com if you're interested in signing up for that. You can also download NKBA's research at nkba.org, select research and the insights tab, and click on market research. Remember, all this valuable research is free for NKBA members. So if you're not a member, please join and take advantage. Thanks again to our sponsor, Deep Drawer, digital marketing specialists focusing on building businesses in the remodeling sector. You can visit deepdrawer.com/NKBA for a generously offered promotion for free digital competitive analysis to NKBA members. Thanks all for joining us. Please follow the NKBA Me on social media, and we will see you next time. Have a great day.